Welcome to our YouTube video on the art and science of calculating intrinsic value. In this video, we will explore the fundamental concept of intrinsic value and its importance in empowering investors to make informed decisions. We will delve into the methodology of estimating intrinsic value, focusing on the discounted cash flow analysis, and discussing the significance of considering enterprise value when valuing companies with substantial debt. Understanding intrinsic value. Accurately computing intrinsic value is a critical tool for skilled investors. It involves buying an asset for less than its true worth, enabling favorable deals, or paying more than justified for future cash flows. Proficiency in gauging intrinsic value allows investors to assess potential returns and associated risk. It combines art and science, relying on estimates and approximate figures to determine the asset's likely true value. The focus is on establishing a general range rather than precise accuracy and identifying a margin of safety between perceived worth and purchase price. The methodology for calculating intrinsic value. The Then the Investor by Mona Spry presents a method for calculating intrinsic value based on discounted cash flow analysis. Let's use the example of Apple stock to illustrate this approach. The method involves predicting growth rates over a defined period, typically 10 years, and selecting a discount rate that reflects the desired return. Terminal value, representing the future sale price of the business, is also factored in. By projecting and discounting cash flows and considering the terminal value, the present value of future cash flows is determined, revealing the asset's intrinsic value. Considering enterprise value for companies with debt. Valuing companies with substantial debt requires considering enterprise value to accurately assess their intrinsic worth. Enterprise value goes beyond market capitalization by accounting for debt and cash on hand. This approach is particularly relevant for companies like Ford, where debt significantly influences their enterprise value and true valuation. By incorporating enterprise value and debt considerations, investors can better determine if a company is undervalued or overvalued. This perspective safeguards against being misled by apparent discrepancies between market cap and true worth due to debt and cash considerations. Mastering the computation of intrinsic value is a pivotal skill for investors, allowing them to make informed decisions. It combines estimation and analysis, seeking a balance between accuracy and practicality. When evaluating businesses with significant debt, focusing on enterprise value ensures a comprehensive assessment of the asset's worth.